numbers coming in from DMart. You have tepid to slightly disappointing updates coming in from retail giants as well, and FMCG updates that have been a mixed bag so far. To discuss all this and more, let's welcome on board Karan Taurani, EVP at Elara Capital. And Karan, hi, morning. Thank you so much for joining us. Give us your first take on DMart's numbers. Largely mixed set, slightly disappointing coming in. Some metrics have done well, but the bottom line has not done well at all. What's your take on DMart's Q1?
Good morning. So I think on the revenue growth side, the numbers are, as per the management update, about 16% odd. You have to look here that there is a clear trend in terms of convergence in the SSG or the LFL growth for a company like DMart, and that's clearly happening because of the pressure of quick commerce in the metro markets and also on the pressure in the FMCG vertical. So there are concerns as far as growth is concerned. This may continue over the near term as well because quick commerce, as we all know, is expanding aggressively. And there are new players also which are coming to the quick commerce business who are also kind of adding a lot of new dark stores. And if at all quick commerce scales up beyond the metro markets, you could see further challenges for a company like DMart as far as SSG and LFL is concerned. The good part is that store addition guidance has been on track. They've added about they are on track to add about 50 to 60 new stores this year. So store addition remains to be healthy. The second good part is that DMart as a company is not seeing too much of competition internally within the other modern trade players in the likes of Reliance Retail and Star Bazaar and so on and so forth. Most of these players are either stable in terms of stores or they are kind of reducing the number of stores. So I think from that perspective, DMart continues to have an edge. As far as profitability is concerned, again, there is pressure therein, primarily because of the quick commerce business, because of discounting. And this may also continue in the near to medium term. Which is why I think DMart is one company which should play primarily basis valuations, because one will not see a big flip or a delta in terms of earnings upgrade, at least in the near term, unless this entire threat of quick commerce comes down beyond a point. So one should play this at valuations wherein the P multiples move below 60 times on a forward basis. One can buy into the stock, and about 70 times P again go underweight. So it's a tactical play as of now in the near term, unless we see some kind of clarity in terms of where quick commerce is going to do in terms of expansion on metro markets and how much scope is there for them to go in the metro markets as well.
All right, so that's the take on the earnings. Hi, Karan. Morning, this is Shrishti also joining in. But with respect to the store additions, yes, DMart has been in focus. But how do you see the LFL growth shaping up? Because in this particular quarter, it has softened further. But in the times ahead, are you anticipating any recovery in this number?
Yeah, so from LFL growth standpoint, as mentioned, we don't see any recovery as such. At best, I think the LFL growth can sustain at these levels or may even see a downfall. What is happening in the metro markets is that a lot of top-up purchases are now driven by quick commerce, right? So I think if you look at the SSG or the LFL, in the first half of the month, it is reasonably strong. But in the second half of the month, because the consumers are doing a lot of top-up purchases on quick commerce, you are seeing a lower SSG as compared to the first half of the month. And I think this trend will continue as a phenomena. And the second thing is that if you look at quick commerce as well, I think about 6 months back, it was very clear the non-metro markets is not meant for quick commerce. But as per our checks on ground, the quick commerce business is doing reasonably well in terms of non-metro markets with a lower AOV. Obviously, they are making losses in non-metro markets because of new proposition altogether. But if at all quick commerce scales up in the non-metro markets beyond a respectable scale, you could see further pressure in terms of LFL for DMart.
So that's the take on DMart. But Karan, let's move away from DMart and talk about some other earnings, some other updates that we've seen in the quarter so far. How are you seeing other retailers like Nykaa, Jubilant, United Spirits? How do you think they are positioned amid the current demand scenario and cost pressures? Do you believe there are any clear outperformers based on the FMCG and retail and QSR updates we've seen so far?
So if you look at the consumer discretionary pack as a whole, there are not enough plays that we have today, basis the growth and the valuation. Very selectively, I think you should play with platform or internet companies which have a safety haven and a high visibility for growth. You can play with the likes of Eternal and Swiggy, which have got better visibility for growth, and the profit metrics will only improve from here on. Nykaa, I think obviously they've done reasonably well. Their growth remains to be very strong, 25-30% in terms of the BPC GOV. But valuations on the core BPC side are at a premium. So one may not see incremental upgrades or incremental re-rating or valuation multiple for Nykaa. The drivers therein are obviously lower losses or a break even in the fashion business, increase in margins for the BPC business. These could be two drivers for a further re-rating and further upgrade as far as Nykaa is concerned. Otherwise, things will remain to be where they are for Nykaa in a narrow band. If you look at the QSR piece, I think too much of concerns there. Because clearly most of the companies are still reporting a negative SSG, except for Jubilant, which has seen a turnaround internally. But again, valuations there appear to be premium. So if you want within the QSR space, one can actually play Jubilant tactically when the valuations reach a reasonable level. And if you look at other names, we like Sapphire Foods as well, followed by Devyani in terms of pecking order. Westlife also is like a reduced sort of rating. But I think QSR is not offering anything exciting because SSG convergence has not stopped. We could see basically SSG growing in terms of the next couple of quarters because of festive season going ahead, and that momentum has to sustain. Second very important thing to watch out in QSR is the store addition guidance. So most of the companies are adding stores. If you look at the KF fried chicken side, there's low penetration in the market like India, so they're adding stores aggressively. But what happens to the likes of Westlife and Jubilant Foodwork in terms of store addition for the next 2 to 3 years? That's a key monitorable. Third, of course, is the margin. So most of these companies have given up on margins anywhere in the range of 300 to 500 basis points in terms of EBITDA margin over the last 2 to 3 years because of rising pressure in terms of dine-in sales and because of increased competitive intensity. So I think the first thing to watch out would be the margins should stabilize, then growth should come back, and then potentially we see margin improvement for the middle long-term perspective. But there's no visibility in terms of how that will happen and how much time that could take, which is why I think Jubilant and Sapphire Foods are the only names that we could play, wherein Sapphire would play for valuations because valuations are extremely low as compared to peers, and Jubilant would play for growth at reasonable valuations. As far as Alcobev is concerned, we do like companies like Radico over United Spirits and United Breweries because Radico, if you look at both from a growth and a margin perspective, they are going to see very strong headwind from here on, strong tailwind from here on rather. If you look at Radico's growth, it's at about 15 to 20% in terms of overall portfolio revenue growth. If you look at the margin expansion story, they could see earnings figure of any between 25-30% over the next 2 to 3 years. So because of the high visibility, Radico obviously valuations are expensive, but we would like to bet on these kind of companies where the visibility of growth is very high. As far as UNSP is concerned, they have their own set of issues. I think with the United Breweries, the volume growth has come to a reasonable level, but the problem is margins. Margins still remain to be extremely low as compared to what they were. They're not able to see a consistent improvement in margin despite even something like a Telangana price hike, which happened about 6 months back. As far as United Spirits is concerned, there are concerns in terms of growth there. Margins have kind of plateaued out at 17-18% for the core alcohol business, and valuations are premium. And the recent impact of Maharashtra is going to be very big for UNSP, given their high exposure in Maharashtra market, and Maharashtra being a highly profitable state in terms of overall profitability. So net, I think we like platform companies like Eton and Swiggy, followed by QSR companies like Jubilant and Sapphire, and then you could place even something like Trent, at reasonable valuations, because Trent, we don't foresee growth rates coming below 25%, in the near to medium term.
All right, that's the take on a whole host of sectors and stocks. But Karan also talked to us about the FMCG and the staple pack, because there the excitement seems to be on the back of the Q1 updates. Markets are finding them to be good, but the other worrying point has been the pricing scenario, because of the competition, because of the low demand within the markets, the companies were not having that pricing power with them. But do you believe even that aspect is getting a bit of a breather? What is your own sense from the channel checks so far?
So I think FMCG is a long way to go in terms of recovery, whether you call it earnings upgrade or valuation re-rating, primarily because of 2-3 reasons. One is, the volume growth remains to be under pressure. If you look at the overall growth as well, you're not seeing any big premiumization trend for the large FMCG companies. And they are underperforming the market. Obviously, they're at a respectable scale. But if you look at the flooding of D2C brands, the new brands which are coming to the market, it's huge over there in terms of opportunity. So I think FMCG companies could see pressure. FMCG companies could also see pressure in terms of overall profitability, because if you look at the quick commerce engine, it is just taken off. For any FMCG company, quick commerce would contribute nothing more than 1 to 2% of sales. But in the metro markets, this number is as high as about 15 to 20% as well in certain categories and in certain cases. So the way quick commerce is disrupting the overall business space, you could see margin pressure as well for FMCG companies. And given the kind of valuations they are, most of the FMCG companies don't offer ample room for re-rating of valuation multiple as well, given the kind of muted growth prospects that they have with the near to medium term perspective. So one would rather play discretionary over FMCG, given the kind of growth rates and given the kind of earnings upgrade possibility in certain selective names.
Right, and Karan, we also have reports that are suggesting that Maharashtra government could be looking to lift the 50-year-old restriction on issuing new liquor shop licenses. Could you tell us what this means for the industry overall and any benefit to any company in the listed universe?
So if you look at Maharashtra as a market, it's about 12 to 14% in terms of broad volume contribution for the larger players. Revenue contribution is anywhere in the range of 15 to 20%. But this could obviously be a positive. The increase in number of outlets by 20% over the next 15 years will kind of pave way for better distribution, better growth in the market as a whole. But I think the Maharashtra recent excise announcement, which has come last month, that is going to be a structural negative in terms of both volume and revenue growth for a market like Maharashtra. So increase in number of outlets will definitely offset some bit of negative impact of this Maharashtra excise hike which is coming, but it's not going to be like a big win-win or a flip because the number of outlets are growing by 20% over the next 15 years, which is not a big number as such. And obviously, Maharashtra is the only state which is not seeing increase in number of outlets. Other states are seeing increase in number of outlets by 2 to 3% over the last 5 to 7 years. So obviously, it's a small positive, but not a big game-changing move for the alcohol players in Maharashtra.
Karan, with this, we let you go on that. Thank you so much for taking the time out and speaking with us on a whole host of sectors and stocks that are in focus. But indeed, Avenue Supermarts is under pressure. Thank you so much for joining us today. But with this, viewers, let's move on and let's also welcome on board Sahej Agrawal, Head of Derivatives at Kotak Securities, joining us on the show right now. Hi, Sahej. Morning. Good to be speaking with you.